Good evening and a very happy new year to all of you at TIE Bangalore. It's a great privilege to talk or interact with you on these regulatory sessions, and it's something which I look forward to. A lot of things have been happening in the regulatory space because regulators try to keep pace with the developments, but it's not always possible for them to do so because they tend to act with a lag because they need to see how things shape out from developments in the monetary in the financial sector before taking action. Some of these developments which I would like to share with you today is regarding one is on the NBFC sector, and the second one is on the introduction of CBDCs, both wholesale and retail, in November and December last year. Coming to the NBFC space, NBFCs play a very critical role in the Indian financial system because they tend to reach out to the sectors or the segments of society which banks normally are not able to access because of their reach, their simpler processes, and in very many of these NBFCs today are also technologically enabled to handle increasing customer requirements, whereas banks are not so technically enabled, nor do they have that reach to cover all those segments which the NBFCs normally serve. But along with this comes a challenge. The NBFCs have been largely out of the regulatory regulatory ambit, in the sense that they had not been subject to so much stringent or tough regulations as banks are, because banks are required. The regulation of banks, the supervision of banks, under a tight fist is required, because a failure of a bank affects the financial system, and the systemic importance of the large banks is also too critical to be ignored by the regulator. It doesn't happen in the case of the smaller NBFCs, but of late there have been developments in the NBFC sector which has shaken the complacency rather surrounding this sector, and also the realization that they are closely interconnected with the financial system, and failure of a large NBFCs can affect the financial system also. So that is where the regulator moved from a simple classification of type 1 and type 2 NBFCs based on acceptance of public deposits and non-acceptance, no customer interaction, to a more scale-based regulation. And in the scale-based regulation, they have classified NBFCs into a base layer, that is non-deposit taking NBFCs with asset size of less than 1,000 crore, and others like P2P, account aggregators, etc. The middle layer, which consists of NBFCs, all deposit taking NBFCs, and NBFCs with non-deposit taking with asset size of more than about 1,000 crore, other entities also including housing finance, etc. And you have the upper layer. The upper layer is normally decided by the central bank based upon their assessment, based upon the interconnectedness which they have with the banking system, the leverage, the type of products they offer, and the risks they pose. It is those entities are classified in the upper layer, and currently RBI has classified 16 NBFCs in the upper layer. As of now, the top layer is empty, but it depends upon the supervisory reviews of the RBI, where they assess the systemic importance of certain NBFCs and they may be placed in that layer. Along with these classifications has come and a requirement for increasing skin in the business. The net owned funds of NBFCs have been revised upwards from 2 crores to 10 crores for new NBFCs who are starting business, who are applying for a certificate of registration from the RBI, and also existing NBFCs are given a glide path to move from where they are from 2 crores or like factors the minimum requirement was net own funds of 5 crores to 10 crores by 2027. So those the goalposts are very clear. Along with this also comes increasing requirements like NPA classification by NBFCs, or based on the 90-day norm, like banks. Again, for the middle layer and the upper layer, it is more on governance, where there are qualifications for independent directors, requirement for a compliance officer, and more governance, the structures in place, including a risk management committee. So it is becoming more tougher for NBFCs to function unless they have strong governance structures, they have the capital, and they have also the expertise to meet the challenges coming from increasingly tough regulatory environment, also an increasingly competitive space in the financial sector. And uh, perhaps one of these reasons is why there's a large number of NBFCs which are surrendering their licenses. And the second thing is, second part of the story is that a number of licenses of the or certificates of registration of the NBFCs have been cancelled by the RBI. Today, as on December 2022, there were around 9,471 NBFCs which were registered with the RBI. And to date, around 5,000 certificates of registration have been cancelled by the RBI so far. The reasons are multifarious. One, it could be them voluntarily surrendering their certificates of registration. The other could also be because of the regulator finding that they do not conform to the requirements of the certificate of registration. Certain things like requiring them to commence business within 6 months, or maintain the necessary net own funds, etc. And this is one of the reasons why it's becoming tougher for NBFCs to function. And uh, increasingly, RBI is also looking at with a closer lens at these NBFCs. There are a number of NBFCs. Being in the consulting space now, I'm approached by a number of NBFCs for various reasons. Some have got a certificate of registration, but they don't know what to do further with it. The business plan is very good on paper, but implementation is a challenge. And by that time, 6 months would have elapsed. And the regulator would be on them, asking them why they have not start commence business, because they run the risk of losing their certificate of registration. The other is NBFCs who who may find challenges in their business model and who would want help in kind of restructuring their entire business model. So there are various types of challenges which NBFCs currently face, and RBI is kind of aware of this because there are a lot of NBFCs, quite a few of the, I would say, of NBFCs who during the pandemic were being used by the digital loan apps, service providers, to take advantage of their NBFC model to extend loans to unsuspecting borrowers, and without any regulatory complying with any regulatory guidelines, which has led to also the digital lending guidelines issued by RBI, which required that if a regulated entity is having a tie-up with a service provider, digital loan app, or other loan service provider, the loan should be, or the payments, everything should be routed through a bank account unless it is sanctioned for a particular purpose. So this was because of the reasons why the NBFCs had been misused rather by these unauthorized companies, rather offering certain products which fall outside the regulatory ambit. Uh, that This has cast a kind of a smear on NBFC, on the NBFC sector as such, and it is time that the NBFC sector revived. NBFC sectors traditionally um, has this I would say, the blame that they are offering products which are not really linked to the cost of funds. Exorbitant rates of interest are being offered on deposits to entice depositors. Of course, a lot of regulation has come in place, but there were times, I remember when I was in the Bangalore office of the RBI looking after the NBFCs in Karnataka. There was a gentleman who was a learned scientist who used to come almost on a daily basis to the bank because he had put in all his earnings, all his retirement benefits rather, into an NBFC, and attracted by the very high rates of interest, which of course they are not able to fulfill those promises, and then the NBFC ran into difficulties, and the poor gentleman's entire savings were lost, and he didn't even have money when he's coming from one of the interior regions of Karnataka to come to Bangalore to stay in a hotel. So these were some of the darker side of NBFCs, which are being kind of trying, which the regulator is trying to see that they fall in line with the same type of regulation that is there for banks, and they are regulated on par with banks. Of course, a lot of leeway is being given to them, but still. But having said that, the NBFCs play a vital role. They looking after a particular segment of society with greater financial inclusion. They have a role to play in financing the MSME sector, and certain segments or sectors of society which banks would find it very difficult to reach. And that's where the NBFC should be able to seize this opportunity to strengthen their systems, build strong governance structures and compliance structures to be both competitive and regulatory compliant. Coming to the second part of it, the RBI launched the central bank digital currencies in for wholesale segment on November 1st, and for the retail segment on December 1st. These were landmark dates in India's financial history, because many countries, almost more than 100 central banks, have been working on prototypes of the central bank digital currency, and there are some countries which um, uh, have already prototype of the central bank digital currency to meet their requirements. But on a large scale, it was China which first tested the digital yuan, which is being used extensively in China, many parts of China, including like places like Shenzhen, uh, uh, their northeastern, western provinces, and on a very large scale. Coming to the Indian central bank digital currency, it is like an idea whose time has come. In the 1960s, James Tobin, the Nobel laureate, said there was a need for the Federal Reserve to have a currency which has something which has got both the security of currency, and also the safety of currency and the convenience of deposits. So this is something which triggered the kind of thoughts on how to develop a central bank digital currency. But why a central bank? First, what is a central bank CBDC? CBDC is a digital form of legal tender. It is the digital avatar of the currency of the rupee, which can be used with the same with the same confidence, the same security as your currency notes, and can be exchanged. It is legal tender. It can be exchanged. It is a store of value, and it figures like any other form of currency in India. And what it is not like a virtual currency or your cryptocurrency. Coming to the digital, to the CBDC, what are what prompted or rather triggered central banks and also the Indian central bank to go in for CBDC when there is a very robust digital payments framework? There's the RTGS, there's the NEFT payments 24 by 7, and also the UPI payments, which more than 75% of the population use very successfully. And during the pandemic, it has grown rapidly. The compulsions for each country are different. When you look at certain countries, it is because of the declining demand for currency, like Sweden. There's a declining demand for currency there. There are other countries where still cash continues to be, if not a king, is a prince, like Germany, Japan, and the US. And of course, India too. People still prefer cash in small value for small value payments because of the anonymity, the ease with which transactions can also be made. And then you have countries where distribution of currency becomes very difficult, and is like the Bermuda, Caribbean islands, etc., where the islands are thrown over a large geographical space, and it becomes difficult to service those islands. And you also have the need, central banks looking for a need for a different type of currency to counter the threats posed by virtual currencies. And this is where I would like to quote Christine Lagarde, the president of the ECB. She was the president of the Central Bank Digital Currency Committee, and she said that central banks have a duty to safeguard people's trust in our money. Central banks must complement their domestic efforts with close cooperation to guide the exploration of central bank digital currency, to identify reliable principles and encourage innovation. And so we come to also the other, the reason why central banks are looking for an alternative to the forms of currency which they currently have. And you also see that other than besides currency, we are talking today of digitalization of currency. But if you see all other forms of securities, like bonds, government securities, etc., in the demat form, are all in their digital avatars. So why not currency? And you also look at the cost of currency management. When I was in the Department of Currency Management, I knew what was the pressures of the cost, the enormous cost, and the pressures of managing currency, of currency management for a central bank. It's not just the cost of printing currency, which was 4,094 crores last year, but it is also the cost of transportation, storage, and also distribution of currency. And again, the reverse cycle. The soil notes flow into the central bank again for being destroyed. So, and again, the cycle repeats with fresh notes having to be printed and issued. So, this is an enormous cost for central banks. And central banks would like to at least reduce that cost on currency printing. And that is also one of the reasons for looking at digital alternatives to currency. The two forms of currency which we have today are at least which have been introduced in India are: one is the wholesale CBDC, which has been used for secondary market transactions in government securities. It has got a lot of advantages like immediate settlement and the not requirement. What is the requirement for there is no need for a collateral, and while there is no need for a collateral to manage that settlement in government secondary market securities. And in the initial day, around more than 50 transactions involving around 370 crores had happened in the wholesale CBDC. You have the read, which is an account based form of CBDC. Then you have the retail, which is token based, and which is basically meant to be used by the retail person like you and me, and for day to day transactions. And here, this is person to person, and also person to, say, merchant. The difference between UPI and CBDC is quite interesting to know, because UPI needs at the background of it a bank account. You request for transfer of money to a person's account. The message goes to your bank account, which is debited, and then the person's gets the money. But in the case of CBDCs, it is like you take the money from the bank either by debit to your account, or you get it in a payment, and that money is like currency notes kept in a digital wallet, and from the wallet it goes to the person to whom the payment is being made. Here there is no intermediary bank involved, and so it is direct, instantaneous, and the person gets the money immediately in his digital wallet. And so it can be used for a multiple number of transactions. So central bank, the currency can be of various forms, but there are certain foundational principles. I hope I've been clear on that. What is the difference between UPI and the CBDC? Yeah, thanks. And coming to the types of CBDC, or rather the forms in which it can take place, it can be in the form of the it can be the directly the central bank can issue the CBDCs. It can maintain the accounts, and it so that's and or in every situation, it is the direct liability of the central bank. Like currency in circulation is a liability of the central bank. That it means that if you approach the central bank at any point of time, they are required to pay it, just like currency being tendered at a bank, and for which you get either exchange of notes or you get it credited to your account. There could be an indirect form in which partly the central bank issues it, then the banks or the intermediaries manage the distribution of currency, and the accounts are maintained by them. Typically, central banks are not geared to have a kind of a situation where they maintain retail accounts, because they are bankers to banks and not to retail customers. Much as I would have loved to have an account with the RBI, I'm not allowed to. And for the simple reason, there's a banker's bank, and the accounts they maintain is that of financial institutions and banks. And the ideal model would be the indirect one, in which the central bank issues the CBDCs, and the intermediaries in the financial system would take care of the distribution, the intermediation of CBDCs. It could be token based, as we have seen the retail segment, or it could be account based. And here there's a challenge whether can uh, the CBDCs have interest, carry bear interest. Now, this would be something which is a thought process. But here, we need to see what is the role which CBDCs are supposed to play. According to a BI's Bank of International Settlements guidance on central bank digital currencies, they had three foundational principles. One is that it must not compromise financial and monetary stability. Secondly, it should complement existing systems and not be a threat to them. So it means that CBDC should coexist with other forms of payments and not be a threat to them. And these are the main principles on which the foundational principles on which they should fund and the central bank digital currencies are expected to function. And based on this, the requirement whether CBDC should bear interest or not is something which is challenging to a central bank and would not really serve the purpose in a financial system, because it would be a challenge for commercial banks then to garner deposits if CBDCs gain interest. And again, because CBDCs um, have the sovereign guarantee, that is, when it is presented, it has to be paid. If a bank fails, a person may lose his deposit except to the amount guaranteed by the DICGC. But if the money is held in CBDCs, it would be a direct liability of the central bank and in order to pay for it. Now, this comes at a cost because the role of commercial banks is financial intermediation. They accept deposits, give loans. That role cannot be replicated by a central bank of the country. So that's why CBDCs would not bear interest, and they would basically be just like cash. Cash in hand does not carry interest. You put cash in the bank, and then it becomes a deposit, and the deposit earns interest. So this is one of the characteristics of CBDC. Coming to what can be the use cases of CBDCs, what else can it do? And what are the threats? Why now, when the UPI is doing well, when there is RTGS, when there's NEFT? There is a challenge which is coming from virtual currencies also. A large segment of the population believes also in virtual currencies. And there has been also a kind of a backlash, you would see, or rather, kind of like people have lost their faith, or cryptocurrencies, virtual assets have lost their charm, which it was there earlier. And this was something um, which they have to look at. And co- um, coming to the type of central bank digital currencies, which CBDCs, which are there, uh, the virtual currencies are not backed by any assets like CBDCs. They are the value which is given to them, or rather which is imagined, is what is being traded for, maybe among them, maybe among those who are accepting or holding cryptocurrencies. And again, there has been a failure of many of the large FTX and others who are who have been trading extensively in cryptocurrencies. And in fact, the people who have no knowledge of what cryptocurrencies are, because a cryptocurrency is not the here, I think one thing I should have mentioned at the beginning is that um, it is the sovereign or the central bank's right to issue currency. And this is statutory as per the Reserve Bank Act. The preamble to the act says the RBI has been set up among other things to regulate the issue of banknotes and to manage the currency and credit system of the country to its advantage. And it also gives the provisions of the act also allow permit the bank to issue currency notes, coins. There are also other provisions in the Coinage Act and others which also provide the central bank the powers and the authority to issue currency, to withdraw it also, demonetization, and on the advise the central government also in this regard. So only the central bank can issue currency. Now, virtual currencies are not under any regulator. Anybody can issue a virtual currency, and the value, it has no underlying asset. It cannot be used as a store of value, and as has happened recently, like many of the exchanges have gone bust, people have lost money, it has been hacked into, and again it becomes very difficult to recover this. So unlike cryptocurrency, CBDCs are issued by the sovereign. They are like your currency, it can be used as a for exchange, as a store of value, and as legal tender, whereas cryptocurrencies cannot. And because of these effects of virtual currencies, one of the reasons which urged or rather pushed the central bank into issuing CBDCs is to protect and at the same time provide the general public an avenue for using virtual digital form of currency, CBDCs. There are people who do not realize the risks also of cryptocurrencies, and that I would say for financial institutions also. I came across a news report of a cooperative bank in Gujarat issuing loans against cryptocurrency. Now, how they value it, how they treat that as a security for the loan, you wouldn't know. It would be at best an unsecured loan, and the people. I don't think that the bank which is managing that knows the risk which is underlying such a granting such loans. So there are a lot of risks attached to this, and it does not mean that every innovation is bad in principle. It needs to be regulated, and there needs to be also an authority which is able to regulate the issuers of digital currency virtual currencies, as is done in other jurisdictions where you have the many jurisdictions like Singapore, the US allow the virtual currencies to be managed only where the exchanges are registered and authorized to deal in such virtual currencies. Otherwise, they are not allowed. And there are always certain jurisdictions where they are not regulated. So the regulatory space is very uneven at the moment, and at least our central bank would not want to take a risk as far as concerned till the laws evolve and globally there's a level playing field and the regulations are in place across the globe. What are the use cases for which CBDCs can have besides being used in transactions? At the moment, what is in place is a trial run. Retail CBDCs have been issued, are being tested rather, though it has been announced. Banks are in the process of testing it and actually seeing that it is used. And looking at the CBDCs, there could be a lot of use cases which can develop in the future, where like the People's Bank of China's digital yuan. As I said, it has been used across many of the regions in China with a huge level of transactions. and China is moving towards, pushing towards uh, uh, transaction based system based on the digital yuan. And for the first time, I think this is one of the first countries to develop a programmable yuan, digital currency, CBDC, where it can be programmed for specific uses. For instance, if we were to use a CBDC for meeting certain specific requirements for subsidies, for fertilizer payments, the CBDC would be programmed, would have a program to see that is meant to use that only. So it obviates diversion of funds, and it helps in ensuring that the payments go to the right persons, right channels. And that's how the digital yuan is also programmed for meeting certain things like certain use cases like meeting the subway, travel in the subway, other retail payments, etc. And it is programmed for the specific purposes. It could grow going forward. It could expand to various other purposes, and the uses as well as the possibilities are enormous once you consider that. Because uh, what would happen is that some of these CBDCs could also be used in the cross-border settlement, meeting cross-border payments. Currently, it is the dollar which is the universal currency, and the US also holds supremacy over SWIFT. But the digital yuan in which China is planning is to be used increasingly in cross-border payments. This could have implications for India also. Imagine a situation where an Indian importer can pay a US exporter in digital dollars. The settlement is instantaneous, and there is no kind of risk of failure of the transaction at any point of time. And this could be without the intermediation of any SWIFT kind of channel. And also the US Fed does not have to be open for these transactions to take place. Of course, central banks will have to work together to have digital equivalent of their currencies so that the process is expedited. So the possibilities are enormous. And that is where also various questions also come up of anonymity. Does cash has certain types of anonymous and anonymity, and what happens to CBDCs, because they would carry a digital footprint. And the thought process behind the central bank at the moment is that small value transactions can be anonymous, they need not be tracked and reported. But large value transactions could have to be reported. Even under the income tax rules, large value cash transactions are required to be reported or not allowed. And there are cash transactions reports which have also to go to the FIU. So there are those transactions which need to be tracked for AML CFT purposes. And that is why it cannot be a totally anonymous kind of transaction which takes place in the CBDC front. And you also have, coming to what the central bank has said, is that we have created a base on which the private sector can build innovative products, either in terms of making related services like access services, distribution, then methods and related services offering, etc., and some support financial inclusion. And this is extremely important because a large segment of our population continues to be still excluded. By financial inclusion, I mean they do not have access to formal financial services like having an account, access to payments, to pensions, insurance schemes, etc. And it is possible that the CBDC can be an instrument for greater financial inclusion, and also in places where there is no internet connectivity, and where payments still can happen using the CBDC method. And China has got a system where they have also had such a have CBDCs which can be used where there is no connectivity, and it requires only two mobiles to be tapped together, and then the transaction happens. So something like that. This is a space. You are all innovators, technical IT professionals, and fintech professionals. So this is something on which maybe you can work on and provide ideas, thoughts for how the CBDC journey can be much more relevant and and valuable for India, and move towards greater financial inclusion, at the same time having, providing greater financial stability and in the country. So uh, in conclusion, I would say that CBD is a journey. It's just begun. There are a lot of things, lot of developments which has to take place in this space, where we have to learn from other countries who have gone much ahead of us, and also tapping into our own innovative selves in this country to see how best it can be used to reach out to the marginalized, those who are yet to come within the mainstream of the financial system, and to make the country a vibrant economy, and to reach that, the trillion dollar economy which we plan to be in a couple of years down the line. Thank you.
Thanks, Teresa. I'm going to ask two people to speak before I open it up for questions. One will be Saurav Raj, who's a startup founder, and I think he was one of the people very keen to get this going. And the other one will be Santosh Kumar. So, Saurav, do you want to kick it off with your perspectives and questions? And immediately after that, Santosh. Saurav, are you on? Otherwise, Santosh, why don't you just start off? Because, I think in the interest of time, Santosh, come in after, Saurav, come in after Santosh. Go ahead, Santosh.
Thank you, Sandhya, and thank you, Teresa. Teresa, it was a wonderful primer into what CBDC is. Just to give everyone a perspective, what I'm going to be speaking is more of a personal view and not representing City here, although that has added to my knowledge base and my experience in this activity. Another caveat is City is not a part of the CBDC initial pilot, but we've worked on multiple global projects on getting different regulators across different countries up and running with the CBDC activity. So we do have some some action globally that we've been part of in terms of CBDC, and we also obviously look forward to being part of the regulatory CBDC pilots in India as well. To add to some perspectives here for everyone on what else could CBDC bring to the table, right? I mean, I think I'm very gung-ho on the global payment ecosystem that is going to be changing over the next probably 3 to 5 years time frame. So today, if you look at it, each and every currency probably has a conversion that has to happen, and it goes through a set of hoops before the money gets transferred between one country to other country. And with the UPI partnerships that the government has taken to multiple other countries, so we'll probably be seeing same-day transfers between Singapore and India. But think of it, that speed and scale multiplied by 100x is what CBDC will bring to the table. These are called as MCBDCs, which is nothing but multiple CBDC, which means that the country to country transaction or people to people transaction across different countries can move on the distributed ledger technology, DLT technology, which makes it really, really seamless and smoother to execute these transactions. For the uninitiated, what it means is that just think of it like how we transfer between banks using UPI rails. The same thing at a global level using blockchain technology will make it much more efficient, seamless, and also cost effective, right? Which also means that there's a lot of use cases that the fintechs could build in future, right? I mean, think of what the Phone Pays, Google Pays, Paytms have done to the Indian ecosystem. Now, imagine these kind of transactions or capabilities that will be built at the global level, right? So, for people to move money, for people to buy and sell assets, for people to invest in other countries, for people to buy goods from other countries, it is bound to be much more simpler. I think the next generation is not going to remember or not even going to be exposed to the challenge that we faced, where we had to carry our traveler's check and forex cards. I think that those days are gone. There are going to be mobile based digital wallets that will enable transaction between the countries. And imagine if you're traveling from one country to other country, maybe you're traveling multiple countries on a Schengen visa, you don't need to carry a euro or a INR or a USD. All you have to do is just keep your digital wallets enabled, and it would be very seamless to make payments across different vendors, different activities, different purchases across different countries, right? So that's one of the use cases that I can think of in the MCBDC. To give you some perspective on what's happening across the world, there are multiple mBridge projects that have been actioned upon. A couple of famous ones are, we have the Bank of International Settlement has done a project with Thailand, Hong Kong, China, and UAE. So the 4 countries have come together and done multiple pilot programs for transfers between these 4 countries. So there are 4 different currencies here we're talking about. Thailand, Hong Kong, China, and UAE are transacting upon. There's Project Dunbar, which is basically BIS again running it with Australia, Singapore, Malaysia, and South Africa. Again, 4 countries, 4 different currencies, 4 different economies coming together and piloting on the CBDC rails. Right. Then there has been a Project Helvetica, which is a very popular one done by the Swiss National Bank. So they've done a wholesale and MCBDC project within the Swiss ecosystem. There's been Jasper, which is Canada, UK, and Singapore. I'm talking about, these are the declared projects by the regulators. There's Project Aber, which is between Saudi Arabia and UAE. There's Project Jura, which is a bilateral project between France and Switzerland, right? And to enable this, a lot of technology companies have come to the fore, like the likes of Accenture, TCS are all working on various projects are supporting the ecosystem. JP Morgan has a DLT ecosystem called Onyx that has been used by a couple of regulators. So there's a lot of action that's happening on the CBDC at the global level, right? So think of it, bringing blockchain, Web3, fintechs all together to enable multiple use cases for people to make transactions in a much more efficient way and make it more frictionless. Right, I'll be happy to take any questions here if you have. And just to conclude my point, I think we're just living in a time which is very exciting, that we are in India, where the regulator is forward looking and putting in a lot of thrust on taking Indian Indian products. That, like, I would say ONDC is an Indian product, UPI is an Indian product. They're all getting global exposure, and there's a lot of opportunity for fintechs to build on these rails. Right, over to you, Sandhya and Saurabh.
Okay. Saurabh, not sure whether you are on. If you are, please come on. Otherwise, anyone else who wants to join in, ask a question, feel free to do so. If you put it on chat, let me just see.
Hi, Sandhya, is this audible now?
Yes, you're now audible.
Okay. So it had hung up. So again, this was an amazing session, and thank you, Teresa, especially for breaking down so many of the myths and confusion that is around the CBDC, versus what it is with respect to UPI versus cash versus crypto. And as much as discussions I have seen across various groups, and that was what prompted me, and I went after something that we need to do something where people start to get a little bit of more of understanding of what it is, even though it is at the very initial stages now, and some of it has been addressed by Santosh as well. So where the way I see it is, for us, a typical fintech was building solutions. The perspective is this makes it very easy and presents a very good proposition when we go and talk to customers now. I'll give you a very simple example. Uh, Typically, when you have to settle payments between two businesses, right, and you have various business systems, ERPs, CRMs, all of those are there. You do all the effort, but end of the day, the payment has to come. Even though after the payment has been initiated by a typical buyer, it takes at least 3 to 4 days to actually land up in your account. In a very simple sense, you see the buyer pays, it comes to the application, the platform, or whichever the marketplace in that scenario is, gets to a clearing, which is again, now you can add T+1, T+2 to all of these steps. So if it's a minimum 2 to 3 steps, that means the money eventually in your bank account is in 6 days. Now, people will think, and if there's a holiday, then it again adds to those number of days. Now, what happens is people think UPI has solved everything. UPI is only solved for the problems when it's very retail oriented, small payments. You pay the guy, it hits his account. Even then, there is a settlement which happens with the respective banks, and it gets done the next day. Now, CBDC, in a way, the digital rupee changes that completely altogether, which means the settlement is instant and true instant in the sense that if I'm transferring some amount, 100 rupees, 200 rupees, or 10,000 rupees to the person in the front, it actually ends up in their wallet. I would not say account, but let's say the account or wallet, let's say both are synonymous, instantly, which means you're not, your settlement time from what we're talking about 6 or 7 days is now come down to 0, which means you have better cash flow, which means as a marketplace, as a business, as a fintech, now I can offer that value proposition to the user saying, hey, you're going to get your money as soon as your customer pays. And which means there's no legacy, there's no downtime within the system which holds up your money, right? And this speeds up a lot of business. This creates a lot of opportunities just at the core implementation level. And that is where the wholesale CBDC, what people call, is going to address those. It will bring a lot of learnings before it can come to more retail. Now, adding to the fact that this is still, I would not even call version 1 or step 1, this is still a step 0 where it has just come. And I feel with the level of financial infrastructure, with the rest of technology infrastructure that we have, which is the entire India stack, UPI, Aadhaar, and then now we have the ONDC. If you see on the digital side, you have the digital health mission, which is coming up. I'm not sure how many of you know about it. And these kind of things, you can envision a scenario in the future where all of those payments, those transactions, those settlements will be so embedded that you would go to a hospital, you would scan your digital ID, and the payments will be routed in the back end as you have approved that, yes, I have been to a doctor, I've done the patient visit, and my bills to be paid, right? Now, what does that mean is the next level of iteration, the next level of innovation which comes on top of this is where you get in the concept of programmable money. Or if you come from a typical Web3 blockchain world, you talk about smart contracts. Today, contracts are very dumb. It's just plain paper. We have done the first step and probably pushed to that limit by COVID, where we have said that, okay, we'll move the digital, we'll move to digital from a pen wet signature, what we call it typically, to a digital signature where using Aadhaar or using some form of cryptography, we can say that this document was signed between two parties, and that will hold in court. Now, the courts also have to accept that. So there is a lot of behavioral change, process change has to come. But what that means now is we have just taken the first step. Now your contract is digitally executed. If you have to raise an invoice under that contract, and if you have to collect payment, you're still down back to the basics, right? Which means you have to raise an invoice, ask for a payment, ask your accountant to check if the money came, and then you have to go and manually, in many cases, cancel and say that invoice was paid. Now, enter what you call as programmable money, smart contracts, which means now you can program, let's say as a simple case, you can say you take up a rent in a place, you move to a different city, you can get into a smart contract with the tenant or with the owner, and then you can say, okay, this is the security deposit. It's one type of a smart contract where you can pay with CBDC. Now, the smart contract says that at the end of the tenancy duration, the amount gets returned to the user unless there is an exception, right? And every month, there is X amount of money which gets paid to the owner, and you don't have to do anything, right? On the back of it, now here is where it gets more interesting. You say you're three friends staying together, which is a very common scenario. When I started out, I didn't have enough money. We were three friends renting a flat together, right? So we did that. Now, the owner can say, I don't want to get into it. I make a contract with one of you guys, you handle the rest, which is fine, which is very fair, right? Then what happens is I can do a second smart contract on top of it, and I can say every 5th of the month, my payment has to go to the owner. So every 4th of the month, what I can do is I need to auto debit my two friends. So which means as soon as this auto debit is done, the total amount is made up, I can pay the owner, right? So this is where it starts to make it very interesting. It starts to make it efficient, and your settlements are more easy. So what outcome comes out of this is that you start to build trust. This today the challenge is you're always afraid. Will the guy run away? Will I get paid? If I do business to a guy, what if he doesn't pay for the services? Today you raise an invoice, and your typical, if it's a big client, they'll pay you within 30, 40, 50, 60 days, right? You're just sitting and waiting for that money to come through, right? But with CBDC and the digital infrastructure, which I still feel is about to come, you will see all of these problems going away. And I'm positive, and we have very smart people working in the ministry and in the finance team. I mean, hats off to them. I can see a scenario where your tax deductions will be at the point of payment versus at the point of generation today. So for example, today, you create an invoice and you have to pay the GST by the 10th of next month. Your invoice is still not paid. You've not even collected the cash. You still, 10%, 15%, 18%, depending on the nature of service or the product you have sold, you've paid that money. Now, the scenario is the client has raised an objection and they're saying, okay, we are not paying. You already lost money on that, right? Now, imagine if this was done via smart contracts, then what happens is that as soon as the client pays, the tax is deducted at that point of time because that rate of GST is already programmed. You've already picked up the SEC code or the GST code applicable to that product service. As soon as the invoice is paid, the tax deduction happens. Part of it goes to the government repository. The rest of it comes to your bank account. And that is where the true power of CBDC, the digitization, the smart contracts is still about to come. And I think being where we are in India, we lead the financial infrastructure around the world, and I think we are at a point in history where I consider myself lucky to be able to see this amount of change happening and be part of this change. So these were some of the points that I wanted to bring to the audience, that we are at the very early stages. I would encourage every one of you to start imagining how the world could be and build on those use cases. Think about that, talk to your other peers, bring it back to the discussion in this forum, send a message to Sandhya and us. We'll have these sessions month on month and kind of encourage those, and we'll build a much better proposition out of this thing. So again, thank you for all of you who could make it. Let's have some questions. Thank you, Sandhya.
I think we have Arvind Tiwari and Kanchan Dwivedi who have questions. So whoever can start off quickly, go ahead.
I'm Arvind here.
Yes.
Yeah. So I heard a lot, and I think there's a lot of words used in confusion. So let me sharpen the question. The RBI CBDC does not use a blockchain. It's not a public blockchain. Israel's is Ethereum. The MAS in Singapore, the project they did with JP Morgan and SBI, that uses a public blockchain and Mbridge from EIS. So it's not a blockchain. But the important question is CBDC a bearer instrument? So a cash is a bearer. I withdraw cash from the bank. I give it to 7 people. Somebody deposits his bank to the bank. The banking system only knows the guy who withdrew, the guy who deposited. Is a e-rupee, the token used in retail, is it a bearer instrument?
Teresa, do you want to take that?
Yes, Arvind is a bearer instrument in the sense like whoever is
The owner, like this is what happens in cryptography, digital tokens, or cash. Cash is a bearer instrument. Anybody who has the physical cash is the owner.
yes.
The paper currency is a digital.
Paper currency is it is a physical form of
yeah,
currency.
it's a bearer instrument.
Yeah,
it's a bearer
instrument. In the
so,
same sense, a digital currency is also a bearer instrument in the sense like it can be used for settlement, for payment of a debt.
no. So the question is, if it's a bearer instrument, if it's in my wallet, it's my private property. The bank does not know that I have that amount.
Yeah, if I may come in, can I answer this?
Yes, Santosh.
Yeah, so this has been clearly put across by the deputy governor and the governor in the press releases, right? You can also look at it in the YouTube video that they've clearly mentioned that they've enacted the law of anonymity on this up to 49,999, right?
That's privacy. See, that's a privacy issue that the legal system.
Correct. So,
the bank cannot give that information unless a
absolutely
court asks for something.
Absolutely. So that makes it anonymous, and also that brings in the bearer capability.
I understand. I run a Web3 group. I understand all this. You are trying to misunderstand the issue. The UPI is very convenient because it's free, and it can be used by anyone, and it is traceable, KYC, etc. Now the e-rupee, to be able to be equally popular, needs to provide some benefits, which is not very clear in the way it is done. It's not on a blockchain, so it's not publicly available. There is a lot of advantage for CBDC for cross-border transaction, examples you gave, and EUN has done it a lot. There's also an advantage of a tokenized thing because it can be done off-grid. As you mentioned, China, you can exchange the token from old user A, who does not use a smartphone, to user B, because it's not on wallets. It's not a wallet. It's a prepaid token instrument which can be transferred. So there are advantages of a bearer instrument which does not depend on a wallet. That is not present in India. That we will figure out. But a CBDC which is not on a blockchain does not provide real benefit over a centralized. Instant settlement is a function of counterparty risk and cross-party settlement. Moment you move to T+0, which is what crypto does, that can be provided. So the advantage of a CBDC which is not on blockchain and which does not provide the transparency, the ease of convenience of a bearer instrument is not clear. UPI is a far more convenient in my mind then.
Yeah, UPI, as is mentioned, is used for small value retail transactions, and CBDC is an alternative to the physical cash, in the sense that, and you have to give it time to build up the use cases and to see how it can transform the in terms of providing greater financial inclusion, where even that connectivity is an issue. People are not able, do not have internet connection and all that. They are able to use it as a mode of for settlement, for transfer of money, etc. And so there are cases which would be coming up, and also in the cross-border transactions, which CBDCs will definitely be far more advantageous. And take a country like India, where there is a huge volume of cross-border transactions happening, remittances coming in from the say the Gulf countries, being sent home. In the sub-Saharan area regions also, where people were receiving remittances from other countries, they found it was at very high cost. But when there is a greater globalization of CBDCs, you can find that the transactions being happening instantaneously and at almost negligible cost. So those are going to be the benefits of CBDC. No, please allow me to complete. So this would be the advantages of CBDCs. So it is not like an idea is for all time. There would be innovations constantly building on it. And I think that is where CBDCs are today, an idea whose time has come. And as the speaker before mentioned, like it is for the fintech community to look at the use cases and see how it can be used to make it more innovative. As the deputy governor mentioned, we have provided a base. CBDCs are based on a blockchain, though it's private, but we have provided a base to allow the private sector to innovate. And that is also something which the Bank of International Settlements, while laying down the foundational principles of CBDCs, said that you should not disrupt the financial system. You should not. It should be complementing the existing systems that includes your UPI and other systems, and at the same time, it should foster innovation, and that's where CBDC is coming.
I would not like to take more time, and maybe in some other session we can recover it. But if you use
Yes.
the BIS project in Singapore, where JPM and SBI in Japan did a cross-country exchange, Singapore dollar, they used a public blockchain, they used Polygon, they used Uniswap, so it was very much the architecture, the layer was a cryptography project. And it was successful because the exchange rate between US Singapore dollar and JPY was managed. The problem in cross-country settlement using CBDC is exchange rate. If you depend on US dollar, you are not benefiting much. You have to have a mechanism of settling the exchange rate and settlement without using US dollar, which is a larger issue than technology. But anyway, let me shut up now.
Give it time, Arvind. It's just started. So I think what you are envisaging will come shortly.
Very good.
Right. That was, that was great to hear all the insights. Thank you, Teresa, for your insights as always. Of the session. I think you onboarded. I actually am
with
Inspire, and which is basically a community of women where we're looking to provide opportunities to women and helping them connect with each other, and maybe in some of the cases women are helping other women. So my question was, I had two questions. One was, is there a possibility of this CBDC being hacked? Is there a possibility? And the second question was around, if the central bank is issuing the virtual currency, then what does it mean for the banks and the fintechs? What kind of role do they play in the system?
On the first one, I think the bank admitted that there is a possibility of the CBDCs being it can run the risk of being hacked. But of course, the systems have to be strong in place so to meet such challenges, like any other kind of system, where you try to safeguard it against being hacked. The second part of the question, I didn't quite get it. What was that?
Yeah, so my question was that, right now we have banks which are transacting in a lot of money, which are, helping individuals get that money and things like that. We have ATMs which discharge money. But if we have a central bank which basically dispenses with a CBDC, then in which case do we need intermediaries? Do we need banks? And what role do fintechs play in this scenario?
You mean to say that if the central bank dispenses, they distributes or rather issues CBDCs?
Yes. So because it's digital money, you need just one person to do it. Why have 40, 100 people doing it?
Yeah. The role of the sovereign or the central bank in this case is always as an issuer of currency. Even today, the physical currency, the distribution takes place through the bank network. So they are geared to the maintenance of accounts, handling the distribution channels, etc. For the physical currency, like you have currency chests with banks where they hold a currency, and then depending upon demand, it is issued across the counters to those who want it, etc. And a central bank is not geared to handle that kind of distribution channels. It is more with the commercial banks, financial intermediaries who are there, who would be better channels for this distribution. That is why you have that, you don't, the direct model of CBDC distribution. That is where the central bank issues the currency, distributes the currency, and also takes care of the accounting, is not considered a very efficient model. It is always considered that if you rely on the existing network for the distribution channels, it would be better. That's where the role of banks as intermediate and other intermediaries, and how the other fintechs can build on it to see further distribute this, to build use cases around it, could really help in developing the concepts of CBDC.
Right. So, Teresa, I explains a large part of what I was trying to also, understand. But my question is, like, earlier we had like money, physical money. So we needed, people to basically manage it. But, when you have digital money, then in which case one single organization can handle all of it. Then in which case, there is no, basically today we have vehicles which are carrying cash. So I can understand that, a central bank cannot handle that. But if we have all computers and everything is virtual and the money is digital, then in which case, why do we need these physical entities or physical banks and loads of money is my question.
I would kind of park that for a longer separate session. Do we need banks? Maybe it's worth having that conversation, because in the first part of Teresa's session, it was about what is the role of the regulator in NBFCs and banks, and if you're going to have digital currency, what will that happen? And I think I think, Kanchan, the question you asked is actually fundamental. In the longer term, we have to see whether, how will this shape up, and we do need to push and ask those questions. But given that we have already almost 15-20 minutes over time, I think we should take it up again, because I think it's worth bringing it up. And for those who are still on the call, thank you so much. What we're using this call is, one, get a basic understanding of what the regulators are saying, but also throw up the kind of questions that, let's say, Arvind and Kanchan are throwing up. And because this also becomes a listening post for the regulators, we do send the invite to the RBI's Innovation Hub so that they can also, if they think that that's something that they want to take up for policy change or for a product change, they're welcome to do so. So I think we are trying to use this forum as a dialogue, even though significantly it's information sharing. So with that, Teresa, thank you so much. Thank you, Santosh, and thank you, Saurabh, as well. And Arvind, I don't know whether you're still on the call, and Kanchan, it's important to keep this dialogue going. Thank you so much.
Thank you,
Thank you, Sandhya. Thank you, everybody. It's been a real pleasure interacting with all of you, and all those delightful thoughts which are coming in, and kind of which can further the dialogue and the CBDC journey. Thank you.
Thank you. I think there was actually if people are still on, Professor Thangavelu wouldn't mind sharing a few perspectives. I don't know whether he has access. He can unmute himself. If yes, feel free to go ahead, Mother.
Sandhya, thank you. Delight to be here. First of all, thanks, Teresa. Greetings from Cambridge, UK. Teresa ji, thank you for clarifying so many things and sharing with us all the happenings, thoughts in your mind. I feel these are early days, and my comment there is, let's be bold, innovate, generate more bleeding edge ideas by bringing together more minds, the people from the IITs and the management schools of India. Let's bring them into this dialogue and maybe hold a series of workshops across India, maybe one every month, looking at these things. Because almost 90 years ago in Austria, we had an amazing experiment that's still can be a model for all of us, the Vogel experiment. And what they did there to get the currency moving, they put a negative interest on currency that is held. And that is a great innovation, and it would have been very difficult 90 years ago when they didn't even have proper computers to run that. And today, with almost instantaneous transactions, this becomes such a powerful and energy-filled way to get growth and all those things related to it. With Sandhya, over the months, we've discussed many, many opportunities in this space. And one important one I just want to share here, thanks to Sandhya for clarifying this, that we need now to put in multiple filters along the way. It's, doing 1 billion transactions a second is not a problem anymore, or even more. We heard from our previous event about these kind of huge transactions, how you generate innovations in that digital coding space, which is a very, very important step, because if that is a cost, there is technology to reduce the cost. Another thing we want to start thinking about are intermediate steps to reduce risk and generate new instruments. So that risk reduction is very important. And the bit that I've talked to Sandhya about, and with several others, is to break down our financial system to generate, in the case of India, state-level central banks and district-level currencies. And that is very, very easy to do, especially with the kind of computing power that we have. And when we integrate that with blockchain approaches, you can make it almost error-proof and corruption-free. And then the other logical step from there on is activity level interest rates. You gave us the example of tunable interest rates in China. The experiment is on. Why can't we do that in India? And with all of these innovations, there is an opportunity for India to become a leader in that fintech area and be selling engines for the future. And I think there's no better place than Bangalore to be based to do this. We have Electronic City, you have all the huge amount of manpower sitting in Bangalore. And the world is looking to Bangalore. And I get strange questions saying, what do they put in Uttapam in Bangalore to get these people to think like this? Give us the secrets. And this is coming from Cambridge, very tiny city. We are less than 200,000 people. But we are called the Nobel Prize factory of the world. A single laboratory in Cambridge has produced over 70 Nobel Prizes in less than 65 years. And so small communities can do a lot. And that's the message. We'll get a chance to talk about all these opportunities for the future in events to come. Thank you, Sandhya.
Thank you, Vardhan. I think today we've had three commentaries which kind of shake the way we look at the financial world. So with that, thank you so much to everyone who spoke today, and hope to see you next month on the topic of privacy laws which have come in. So thank you, guys.